In terms of succession planning for, you know, families that invest in property, what would you say succession planning is?
To put it in really simple terms, so succession is passing it on to the next generation. So as succession planners, we work with parents who want to pass their assets on to their children. And
Mhm.
people will automatically in their head go, okay, so that's all about writing your will, which is correct. Your will comes out when you die. It's the end, it's the very last thing. If you have an estate and you have, for instance, if you have inheritance tax on your estate and you write a will, the will isn't going to deal with your inheritance tax. It's going to distribute your assets. And if you die and you have an inheritance tax liability, you're going to have an inheritance tax liability on your estate. What we do is we work with people during their lifetime. So it's lifetime planning to make sure that they're buying things in the right way, thinking about the future, thinking about this is an asset I'm going to pass on. So planning for that when they purchase it. So we work with clients, for 10, 20, 30 years before they die to help them to structure their estates in the right way so that it is appropriate and as effective as possible when it comes to succession. So succession planning is the lifetime of planning that you do with succession in mind. So I think often whenever we have conversations with professionals, financial advisors, accountants, our focus is always on ourselves. It's on what do we look like today and what's the best way of moving forward for tomorrow, for the day after, for provision for retirement and all these things. And very often it's focused on our lifespan. So it's save today because you're at work, because when you retire, you're not going to be at work. So you need to make sure you've got income. Um, when you start to then think about succession, it puts another level on top of all of that planning, all of that advice, all of the sort of professional thinking that you do. So if you're someone who is planning for a succession, you need to build it in to your sort of lifetime of planning, and it's something that you do throughout your entire life. So that's what we mean when we say succession planning. It's the
Mhm.
lifetime of planning that you do that is slightly different because you're someone who's building capital. You're someone who's planning to leave capital, planning to leave a legacy for the next generation, and because of that added sort of dynamic, it means that you need to start to consider other things.
But why should somebody go for succession planning?
Inheritance tax is 40% after you've got certain alliances, and so you've got alliances like everyone can pass on £325,000 tax free. That's your nil rate band.
Mhm.
If you own your home and you're passing your home to your spouse or your children or your direct bloodline, and your estate is under about 2 million, you also get a residence nil rate band, which means that an individual can pass on 500,000, a married couple or civil partners can pass on 1 million tax free. Um, there are also reliefs. So, for instance, business relief. If you have shares in a trading business, you can pass your business on to the next generation tax free. There's a number of reliefs and allowances, but everything beyond that is taxed at 40% for inheritance tax, which is obviously a significant chunk of the estate that you've built. Um, so inheritance tax does seem to be a driver for a lot of people if they don't want to sort of have that tax burden on the next generation, or even if they just want to make sure that there's provision in place to pay that tax burden, which means that it'll simplify the process when they've passed on for their children to deal with the estate and inherit the estate. They may want to make sure there's provision in place to pay whatever tax is due. Um, but that's not the be all and end all. There are a whole range of things that people need to think about in succession. When we're running our own circumstances, when we're in control of our own circumstances, we think that everything's fine. But the moment that we're not fine is when our circumstances change. If I've died, if I've had sort of a very serious sort of illness or a very serious accident, which means that I'm now not in control of my circumstances. Now I've got a problem.
Mhm.
So succession planning is all about it's about making the provision for when you have that problem, and it's a when. It's not an if. Everyone will die. Hopefully you'll be healthy until you die, and then you'll die sort of in your sleep. But a lot of people get ill before they die. So it's a when as opposed to an if. So it's making provision for when we're in those circumstances. Now, take yourself out of that equation. If you control everything, if you make all of the financial decisions, somebody else now needs to control everything and make all of the financial decisions. If you're very heavily involved in property portfolios, if you're very heavily involved with tenants, very heavily involved with agents, very heavily involved with fixing things around the house when things get broken, or even just arranging the plumber and the electrician and whatever else. It can be a really hands-on job. Now, take yourself out of that equation. Who's going to do that really hands-on job? Who has the experience? Who has the know-how? Who has the relationships to be able to manage that smoothly? Um, a lot of property investors, if they've been investing in property for 10 years, 20 years, 30 years, they have a whole lifetime of experience in terms of how to actually look after that portfolio. And also they have a very personal interest in that portfolio because it's theirs. Um, so you lose all of that expertise. And it is expertise. There's a lot of very technical things you need to be aware of in property, and you gain that experience over time. You gain that experience because things go wrong and you've had to deal with it. You've had tenants that you've had to evict. How do you deal with that process? Um, Now, if you're gone from the equation, you've potentially lost the person who has that knowledge and that expertise. So there's a very practical side to running a property portfolio that needs to be replaced. Um, you also have the fact that so if you yourself have a large estate and let's say you have four children, now your estate's been divided in four. Now four different people may be getting involved with the estate and trying to figure out what to do. And there can be complexities there, from professional services, how to divide the assets. Um, there can be complexities in terms of those people deciding what they want to do. Do they want to maintain the portfolio together? Do they want to, does one of them want to sell? Does one of them want to keep it? Does one of them want to keep it? Doesn't want to be involved? You've got four different people now here all making decisions. Go down another generation. If each of those four people had two children each, now you've got eight. So with succession, there are all of these sort of dynamics at play that need to be thought about. And when you're an individual with a property portfolio or an estate that you're looking after, you're making the decisions and you're doing the practical work, you don't think about how all of those dynamics will come into play.
Mhm.
And again, it's when they come into play, it's not if.
The way that you do succession planning is you kind of put your properties in the trusts, etc. And obviously, I'm sure there's so much more. But is there kind of any tax benefits now of you doing that? Is it a way of structuring structuring things so that you know the, the rent goes into one place and you benefit in other places? Is there anything day to day that's the benefit?
So it's a really good question, and I think this is also where a lot of clients, a lot of clients come from. So the first thing to say is you can't just put your whole estate in trust, and
Mm-hmm.
people don't understand that. People don't know what a trust is. Not really.
I
They
don't
don't
know what a trust
understand how
is.
a trust is taxed. Not really. Yeah. And I think there is this sort of notion you come across a trust or someone's talking to you about a trust and you go, okay, great, a trust is my solution. Let me put my assets in trust. So an individual can settle £325,000 into trust. It's a gift from them into a trust. Everything above that would immediately be taxed at 20%, which is the lifetime rate of inheritance tax.
Mm-hmm.
So let me say that again. If I have £1 million, I can give £1 million to my son, and there's no immediate tax. £325,000, my nil rate band, is going tax free. The remaining 475,000 is going as a potentially exempt transfer. If I die within 7 years, part of that gift is still going to be taxed for inheritance tax as part of my estate. So it's potentially exempt of inheritance tax, but I have to survive 7 years. There are no potentially exempt transfers in trust. So I can put my nil rate band in trust, my £325,000 in trust, but everything above that, there are no potentially exempt transfers. So everything above that would immediately incur a 20% inheritance tax when I make the gift into trust. And people don't understand that. In different countries, it's different. So in America, for example, that's what they do. You build your £10 million estate, you put it in trust, and then that deals with probate and that deals with a lot of the issues in the American system. Um, and there are no tax consequences to putting your £10 million estate in trust. In the UK, the rules are completely different. If you try and put a £10 million estate in trust, you're going to pay almost £2 million of inheritance tax right away, and people don't understand that. So trusts
So
are
what would
incredibly
you do
useful.
if a client came to you with that issue? Without obviously giving away your secrets, what would you do, to alleviate that?
What would we do? So we still use trusts, and that's the thing. So trusts are a very useful tool for inheritance tax. The reason they're a useful tool for inheritance tax, as an individual, if the assets are part of your estate, when you pass on, you'll have 40%. When your children pass on, they'll have 40%. When their children pass on, they'll have 40%. And the generation tends to be maybe 25, 30 years because we have children when we're 25 to 30. So every 25 to 30 years, your family estate is being taxed at 40% to inheritance tax. When you put assets in a trust, the trust owns the assets and the trust can survive for 125 years. So it doesn't have that 40% inheritance tax every 25 to 30
That has
years.
a 20% at
So,
the beginning, and then that's it.
well, no, so we use trusts in a way, so we have to be strategic with it. And again, that's why we like working with clients whenever perhaps they're that little bit younger, because we have time to work with them to help them make um, sensible decisions over time using the things that are available to address the existing inheritance tax, but also we can help them build their estate in a way that's going to mitigate inheritance tax, building the estate. So, um, so it's not that we don't use trusts. It's just that it's a lot harder to use trusts than anybody gives us credit for. But we
Yeah.
still do use trusts, and we have to be strategic in how we use trusts to get the kind of impact that people expect.
Hmm.
Because it's not as simple as taking your assets, popping them in trust, and then not paying tax. The other thing with trusts is essentially you're making a gift. So if you make a gift for inheritance tax, the gift so it'll take 7 years for that gift to fully leave your taxable estate, first of all. And then second of all, you have to give the asset away. You can't reserve a benefit. So there's this rule in inheritance tax with gifting called reservation of benefit. If I give you the asset, but I reserve a benefit in that asset, from an inheritance tax perspective, I haven't given a gift at all.
Hmm.
So people need to realize when we're working with trusts, you're giving gifts, you're giving away the asset. So, um, so it sounds very negative, but in reality, trusts are still incredibly useful tools. You just need to know how to use them in order to get the outcome that you're looking for. And
Gotcha.
that's why you engage someone like myself, because I can help a client, with a multi-million pound estate, I can help a client to use trusts in a way that's going to mitigate the inheritance tax.